Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
Thank you. So there's been a lot of reporting recently about the stress to private credit markets and the potential looming defaults. There's a lot written today, even in the Wall Street Journal, about this topic. We thought it would be helpful to have a discussion about how lenders can protect themselves when originating loans and during periods of distress as it relates to the private credit market. Just to quickly introduce for you who's here with me. On my left is Andrew Rabinowitz. Andrew serves as the president and general counsel of Arena Investors Group Holdings, which is an affiliate of CC Capital, which was founded by Chin Chu, an original member of the Blackstone. Before joining Arena, he was the general counsel of 26 North with Josh Harris, and earlier in his career, he spent 2 decades at Marathon Asset Management. Next to Andrew is Jeff Marwell. Jeff is the founder of Ocean Boulevard Strategic Advisors, has 37 years of big law experience in corporate restructurings and Chapter 11 cases. He serves as an independent fiduciary for middle market private credit lender borrowers and is currently a member of the board of directors of Encyclopedia Britannica. Prior to these roles, he was co-head of the bankruptcy and restructuring group at Proskauer. Next to him is Hadley Ma. Hadley is the founder and managing partner of Fergana Investment Partners, a hybrid capital firm that provides flexible financing solutions to middle market businesses. Prior to founding Fergana, Hadley was a senior managing director at MGG Investment Group with $6 billion of assets under management. He served as the head of originations and underwriting and was a member of the investment committee. And finally, at the end is my partner, Jeff Clausen. Jeff focuses his practice on international asset and judgment enforcement. His extensive experience in monetizing loans in default situations through cross-border litigation and investigations, and has particular experience with enforcing efforts involving investor-state disputes that may involve state immunity. So I thought the best place to start, if we're going to talk about private credit, is to just start with a working definition of what is private credit. And for that, I'll turn to Andrew Rabinowitz.
Thank you, Steve. There's 2 things I can't figure out in life. The first, and we just came up with this question, the first is what to buy my wife for our anniversary. I have no idea what to do. And 2, thank you for laughing, I go on stage at 8 o'clock at the Apollo, no. And the second is the definition of private credit. And why don't I understand that? Because I've recently spoke at an Ernst & Young conference on this exact topic. Because the market doesn't know how big the market is. What do I mean by that? Apollo tells you it's 40 trillion. Wellington tells you it's 30 trillion. ChatGPT tells you it's 1.5 to 2 trillion. Fidelity tells you it's 1.8 trillion. And Morgan Stanley tells you it's 3 trillion. So what is private credit and why are the definitions and size so diverse? It depends how broad you classify the definition. So when Steve mentioned he was going to ask me this question over there about a half hour ago, I wrote down how big or broad the definition can be. It could include warehouse financing, fund finance, music royalties, corporate loans, equipment finance, inventory finance, auto loans, home improvements, residential mortgages, CRE debt, aviation finance, rail car leasing, infrastructure, agriculture, and the like. And then you have a lot of demonics. Is it distress, ABL, ABF, BDCs. So basically, to sum it all up, what private credit is it's non-traditional lending, given the regulatory changes post the Great Recession, where banks, it's cost prohibitive for banks to do these loans to companies, depending on the structure. 90+% are variable rates, and they're usually backed by something, either a hard asset, intellectual property, cash flows, EBITDA. Well, that's the definition as far as I know, and if anyone has ideas for my wife, please let me know later. Thanks.
Hadley, I take it you have no anniversary ideas, but how about your take on that definition?
I would agree, and yeah, I don't have to worry about buying anything, so I can focus on the question at hand. I think I would agree. I think the primary focus in the newspapers and press and the hysteria, I think, has been focused on the direct lending market, which I would say is only, some say it's 10% to 30% of that market of private credit. And so, I think there's been a lot of focus there because that has been the most attractive asset class the last 10, 15, 20 years since the great financial crisis, because of the significant regulation and lack of capital that's been there. So they've really replaced the syndicated leverage finance market. The large cap high yield market has really just gone to those balance sheets. I think one thing that time will tell is the outcome of that, but I think it'll just come down to reluctancy on mark to market and taking marks or not taking marks, and what the secondary market will do to hoover up or not hoover up portfolio sales. I think that'll be a big observation or trend to monitor the next year or two. And then also the banks fighting back, as you probably see sometimes in the back of the newspaper around continued deregulation by the current administration for the banking sector, so they can continue to lend and unwind some of the heavy regulation that they had at that time. But people also need to remember they were levered 10 to 1 plus, the banking institutions. The BDCs at most are 2 to 1, 1 to 1, 2 to 1. So it's a little bit different underlying circumstances and variables that are impacting this part of the cycle.
Andrew, I want to kick off when we're thinking about sort of the originating loans. You touched on sort of asset-backed loans and otherwise. When you're considering originating loans, what are some of the considerations that you think about that sort of shape the deals and mitigate risk at the outset?
Let me start with the last part. So some interesting stats. Currently, 12% of PC loans are PIK. That's double the size it was 5 years. Incredible, right? 2, if you look at the IMF study that recently came out, 40% of borrowers currently have negative cash flow. That was 25% 5 years ago. This one was my favorite, things to worry about. MSCI did an incredible study. Semi-liquid funds 5 years ago was 6% of the market. 94% was closed-end. Gradually increased. Guess where it is today? Today, 53% are semi-liquid. 53, up from 6. 47% are closed-end. So structural changes, issue. PIK, increased PIK, issue. Third issue, how much money has been raised? The Fed estimated that 10 years ago, the private credit market was $350 billion. Guess how much money was raised in private credit just the last 2 years? Over $700 billion. Too much money has been raised. So too much money, bad structures, PIK, those are some issues that highlight. And then also if you look at the underlying investors, and yes, I am a high net worth investor, so please do not take this as an insult. But when you look at how Blue Owl raised its money, according to Reuters and other studies, 40% came from high net worth. Why is that a problem? When you have such concentration of whether it's fund of funds, endowment foundations, high net worth, there's risk because they tend to think similarly. Even though you're diversified, if Morgan Stanley or Goldman Sachs or JP Morgan say sell, they're selling. They're not individual investors. What to look for, I'll be really quick. Look at collateral, strong collateral packages, structural protection. I am a lawyer. I was president of Marathon, but the last many years I've been a lawyer, and structural protections are key. Revenue predictability, negative cash flow is bad. Loan to value, super important. PIK we talked about, and then industry. There's some probability we go into recession. Oxford Economics just downgraded global growth from 3% to 2.5%. So inflation going up. So because of that, you want to focus on recession resilient sectors. Obviously, the one that stands out the most is healthcare, but there's obviously many others. So focus on things that can hold up well if there's a recession.
Thank you. Hadley, want to get into sort of the nitty-gritty a little bit when it comes to sort of your considerations of when issuing a loan. What types of structural protections and diligence steps do you think about putting into the documents and otherwise when you make these considerations?
Yeah, I'll start by talking about philosophically how we look at stuff. I think everyone in this room, we're in the business of evaluating human capital, and I've been investing in the middle market, low part of middle market the last 20 years, and that's a little bit different than the large cap and upper middle market, where evaluation of the management team and the founder entrepreneur is very important. We predominantly do non-sponsored opportunities, so that is a big part of our diligence process, and that is the lens we look at. How do we structure all our protections? How do we bolster the base layer of just how do we think about security interests, like perfecting security interests all the way through, not just the collateral itself. I think that's just the base layer. I think there's other aspects of protecting our interests, which is, and perfecting, which is the timing of going after the collateral, or whatever that may be, the cash flows. That is always not perfect. How do you get at that quicker? For example, we've had to we typically get read-only access to their bank accounts, all of them. So we have pretty good instantaneous access or visibility. We also see or get read-only access passwords and put those in obviously an escrowed box or account where we can quickly get access to their intellectual property and other aspects, even though you have it as collateral, to actually be able to enact on it, enforce, and then make sure there's continuity of operations as you're working through a restructuring or forbearance or other things. I would say those are the, we can continue going through some other aspects around corporate governance and so forth, but a lot of it has to do with who you're partnering with and ensuring that there is a balance of making sure that you are motivating them and have certain alignment of interests, but also not dissuading them too much where they throw in the towel or behave irrationally or act irrationally. And you need to make sure there's a fine balance there, but also making sure we have the right protections. I would just say on the underwriting side, there's a few things along those lines. I think folks have really underweighted underwriting the exit. And especially with the proliferation of capital that folks here have mentioned, right? There's been a rush to put money to work, and a real underweight of how do I actually get out of this? Oh, we can just refi. Well, okay. Well, you still need someone to actually understand who are those likely parties in various scenarios. So I think that's important. And then secondary source of repayment. I mean, if we think about all the businesses, whether at M&A or prior firms that were tough workouts, I mean, you know some of them, secondary source of repayment is something that has always gotten us through.
And are these the considerations that you're taking into account at the origination stage? And maybe you could tell us about sort of some of those conversations as you're also in a competitive environment, so. No, there's a balance of trying to tell the entrepreneur or founder that you require a board seat or independent to be on the board at inception, or changing the corporate governance docs, or forcing them to establish a proper board governance before we go into a deal. Look, I think a lot of times these folks, great operators, but they're at the businesses we look at are some sort of inflection point. That could be distress, could be growth. And we are providing capital in lieu of a bank and in lieu of dilutive equity. So it's always a balance of
what economics they want to give up versus what protections they can provide us. And I think that's the zero-sum balance of, okay, we can be a little more compromising on some of these economic terms, but we need to be able to protect ourselves in X, Y, and Z ways. Folks, we've done everything from, PGs and leaning up other collateral that's outside the actual borrower to, as mentioned, amending and restructuring the underlying operating documents of the legal entities to ensure that we have other abilities to make sure that we have protecting our best interests. So I think there's a lot of other tools that we use or enhancements. The board one is one that Jeff can talk about as well, but is something that we've used quite a bit. And not only does it help protect us, but also it allows someone to be in there ready and to be up to speed on everything that's going in. I think everyone's had experience here where you go into a restructuring and then everyone is scrambling to get up to speed on the situation and how to actually enact or not enact. And then I think in our part of the market, the threat of a lot of the perfected interest that we have is good enough with these counterparties. But you also need incentive and a carrot. So the natural, the carrot and the stick is very important when dealing with these management teams and founders, entrepreneurs, and having that balance of not pushing them too far where they say, you know what, you go figure it out yourself, or worse, they try to commit bad acts or acts of desperation when their backs are against the wall.
I want to get into the issue of board seats in a second, greater detail with Jeff, but just some examples of the incentives that you're talking about. So we can all think of the guarantees and otherwise on the negative side, but examples like when you're thinking about how to align management or founders, what are some of the things like incentives that you might build in?
To be honest, a lot of it can be economic. A lot of it can be along the way. The more you can have a seat at the table, the more you can constantly iterate and mark to market your interactions and relationship with them and figure out what. And a lot of it times it may not be economic. It may just be, look, you should bolster, or you should put in a lot of businesses don't have a CFO or even controller, right? So there's a lot of financial control enhancements that we try to provide. But a lot of it starts in the beginning, which is, are we partnering with someone who values us as a partner? If they think we're a commodity provider of capital, or they're looking just for the cheapest cost of capital, that's just fundamentally not the right partner for us. Right. So a lot of it just goes back to the relationship that we're initiating and building upon with that counterparty, and whether or not it's going to work. And so it's really level setting those expectations.
One thing you mentioned was read-only access to bank accounts. That's something at the inception you
yeah.
Okay, yeah. Which is fascinating, because Jeff will talk about later on is our experience with handling personal guarantees that were provided at the inception, and how different reality is to what's in those personal guarantees. So interesting that you're getting access at the inception, at least, to even the corporate bank accounts, to see how real-time visibility as to how the business is doing.
Yeah, correct. And a lot of this is from lessons learned from situations where you have a PG or other collateral or other remedies, and then you go through it and you realize they don't actually work the way you think they do.
Right.
And you got to fix it.
Yep. That's when the enforcement lawyers come in and sadly have to tell you that.
Exactly. That's how we met.
Right. Okay, so Jeff Marwell, I'll give you a question I know you're going to know the answer to, because you've written about this topic, which is, so why and when should private credit lenders require borrowers to maintain an independent director or manager on the board? Hadley talked about doing it at the inception. I know you have some views on, in the continuum, the considerations and when it should be put in place.
Sure. Thank you, Steve. So first, an observation, if I might. I look at private credit as the new private equity. And from what I've just heard from Andrew and from Hadley, it's confirmed that private credit is non-bank lending for the benefit of individual investors, commercial investors, et cetera, but not regulated. And at the end of the day, that private credit investment, like private equity, it's just one step up in the capital structure, maybe. And as a result, private credit lenders generally had never thought to have board seat representation at the inception of the loan. But what we're hearing and what we're seeing now is private credit really is the business partner of equity. And they're not simply a lender, they're really a partner. And as a partner, they should have some say in corporate governance and in decision-making related to the operations and the best interests of the company. So what is the point of entry for private credit into the corporate governance structure of the borrower? Hadley says it's right at the beginning, at the time of loan inception. And that works in a lot of situations where you may have less sophisticated lower middle market or mid-middle market borrowers who are not private equity owned. The private equity owners, true private equity, are unlikely to embrace an independent director from the get-go, but given the partnership that they're really engaging in with a private credit lender, it's not unreasonable for the lender to expect that. If you're not able to get a private credit lender borrower to put an independent director on the board at the time of loan inception, it ought to happen automatically at the time of default and the time of forbearance. And a condition to continued forbearance, in my view, should require the appointment of an independent director consented to by the lender. And that independent director then should have access to everything. Whether that independent director ultimately takes control through the board flip or through some other mechanism is down the road and not something that needs to be handled or decided at the time of appointment. But the sooner an independent director gets in particular in the face of a default, and the kind of defaults that Andrew's talking about are significant and value destructing, depending on timing and depending on what the business is. And we've seen software service businesses as part of private credit portfolios. Everybody's scared of them. The market's scared of them. I think the private credit lenders themselves are scared of what's in their portfolio. They may not necessarily understand what's going on there. The sooner an independent director with some experience, both on the governance side, not necessarily industry-wide or industry side, but an understanding of how business works, how cash flow works, what annual recurring revenue is, which are the basis for a lot of private credit loans these days. The sooner an independent director gets in and gets a handle on what's happening, the more effective that person can be no matter what happens down the road, whether it's a disaster that requires a sale or worse, a liquidation, or a restructuring that may require current equity to either walk away or current equity to invest additional capital, either of which require current equity to make decisions as board members that are interested decisions. Hence, an independent director can come in and exercise reasonable business judgment, be protected by the business judgment rule, make the decisions in the best interest of the company, which protects equity and the private credit lender.
One quick point. I completely agree with everything Jeff said. Just one thing to consider is when you're negotiating a loan, you may want to pre-approve, here's 5 independent directors, that if something happens, and then you could have Tom, Michelle, Mike, whatever the names are, and it gets pre-approved so you don't have to fight about it when things go bad, because when things go bad, it's hard to negotiate.
There's an interesting article in the ABI Journal back in October that talks about all of this. The author is me. So.
It seems this would be sort of an obvious protection that a lender would want to employ. Hadley, is it a standard protection at the inception, or is it sort of still outside the norm? And Jeff, if you want to weigh in also, is this, Is this still the anomaly where you're basically competing against market forces where you're probably not going to be able to achieve that? Or is it becoming more standard where, putting in place independent directors is sort of a, part of the playbook, the initial playbook?
For us, it's part of the playbook, but we probably get it 3/4 of the time, 75%. Whether it was at MGG or here at Fergana, so it's most of the time. But again, we're in the lower part of middle market where it's different, right?
Yeah.
You're not going to get that with all private equity sponsors. You're just not, right? But what Andrew said is important. Having a list that's pre-approved, so that's very important. So that's at a minimum. But for us, we typically get it. Most of the time, though, they actually embrace it. We're dealing with 2 situations right now where they embrace it because the person we would like, or the roster of 2-3 folks, are folks they already know in the space, ex-operators, retired folks who are just in the business of doing independent board roles, who still have some of our best interests in mind. Will do a great job as fiduciary, but also add value to the board versus just not really filling any sort of value additive role.
And Jeff, you're putting them in as an independent director, you're getting the visibility and the role, the fiduciary role and otherwise. But am I right? You're not actually talking in the first instance of a control flip. You're thinking that gets built in based on certain triggers or defaults or otherwise?
So depending on when the independent director is appointed, if it's at the time of forbearance, the role of the independent director really is to get a handle on what's happening for the benefit of the lender, but also for the benefit of all of the stakeholders. In default, the company has issues for sure. And the independent director is there really as protection for the equity and for the equity board member appointees. At the same time, it's protection for the lender and making sure that a transaction isn't proposed or pursued to the detriment of the lender's value interest at the time. And I liken this to equity out of the money is likely to go buy a lottery ticket with their last dollar hoping to win, where the lender would say, no, I want that dollar preserved, and if there's value in investing that dollar, let's see it, and if not, I want my dollar and I'm going to go home. So bridging that gap between the lottery ticket and keeping the dollar is what the independent director's job is. And every situation is different. At some point, the independent director may go back to the lender and say, forbearance period is ending. This is a big mess. I recommend that you exercise voting rights based on the proxies that you have in connection with your loan agreements, and wipe out the existing board, put the independent director in as either the sole director or add another 1 or 2 independent directors, hire a CRO, and look at restructuring or look at sale.
Jeff, because many of the businesses are either founder-led or even sole owner-led, those individuals tend to have some greater visibility as to sort of when a company, call it, is going into a zone of default. In other words, where there might be some problems on the horizon. And I know in your experience, you tend to see strange things start happening to collateral and assets and otherwise, sometimes even a year or 2 years out before a default even happens. Maybe you could talk about some of the red flags you look for and some of the consequences that happen once those asset movements begin.
Sure. Let me just start by saying that, as Hadley mentioned, secondary sources of repayment are very important, at least in our experience, what we've seen in the direct lending space. When you have an entrepreneur, founder, getting a personal guarantee from that individual or maybe that individual's family members can be important as a secondary source of recovery, often because the borrowing entities may simply not have sufficient assets to cover the debt, and you may have pledges of assets that are not sufficient to cover the debt, et cetera. So even in those situations, though, what we have seen in some of the cases we've handled here is that you start to see the founders start to move his assets to family members or to other people, which you really wouldn't know about unless you're regularly monitoring those assets. So, we've had situations where at a certain point you see the founders start to transfer assets for no consideration to the spouse or to the children, right? And if you can find out about that, which is not so easy, but if you have in place a system to try to monitor the assets that at least you know about, and maybe ones that were not even disclosed to you, but that you've independently learned about, you can pick up additional red flags of signs of distress. And then, that can also inform how you want to go about a negotiation of a forbearance and things like that. The case where actually we worked with Jeff Marvel on was a situation where I don't think there was built into the loan documents the board seat, but that's ultimately something that got negotiated after our firm did an enforcement campaign against a personal guarantee. So there was a situation where the guarantor had guaranteed the loan, and we pursued that individual's assets around the world. I mean, there were assets held through structures in the British Virgin Islands, like art collections. There was a vineyard. There were bank accounts in Switzerland. There were assets all over the world. We developed and implemented a judgment enforcement campaign. We froze assets. We got a receiver appointed in the British Virgin Islands over one of the companies that held the art collection, and put a tremendous amount of pressure on the guarantor to essentially come to the settlement table. And I think that's what then resulted in a deal whereby Jeff actually became a board member. Yeah. So the two can actually go hand in hand, the sort of personal guarantee and other sources of secondary payment, and then potentially the board seat as well.
By the way, there's plenty of opportunities, but the market's smart. So I ran 2 companies before I joined where I am now, and why is the market smart? Like, the people in this room are brilliant, and the people who manage money are brilliant. Why do I say that? Because if you look at continuation vehicles where the market was stressed, the last 3 years they raised $2 billion. But then the market, guys like us, realized, hey, the stuff may be hitting the fan. If I grew up in Queens, so I would normally say, what's hitting the fan? But I'll just say the stuff is hitting the fan. And last year they saw the stress in the market. So GPs like us and others raised collectively $16 billion. So you had $2 billion, $4 billion, $2 billion, $2 billion, $16 billion, because they realized that some of these issues that we're all talking about would create stress, and there would be great market opportunities to buy things at deep discounts. So there is good opportunities in the market, but we are talking about the challenges. Was I allowed to say that, Steve? Is that okay?
Yeah, absolutely.
All right, so
absolutely.
I have to check with Steve because he's an important friend.
Jeff, how about what you've seen, sort of the use of personal guarantees, and how effective are they when it comes to, at the end of the day, if you need to try to enforce on a guarantee?
Yeah, so as I mentioned, they can be very helpful in pursuing assets. One thing that we are seeing, is kind of goes back to the asset transfer thing, is that even the personal guarantees that often include requirements to provide updates on assets and annual personal asset statements and so forth that are provided to the lenders, we see that those are not actually always accurate, right? And I think when you're in the sort of the lending space, there's a difficult balance between how many resources do I put into actually monitoring these assets, as opposed to just trusting that these disclosures are accurate. And we've seen cases, both involving fraud, actual fraud, and then also cases involving, not real fraud, but borrowers being cute with what they're disclosing. So just to give one example, we have a matter where the personal guarantor had disclosed ownership of personal assets that are high value, including a $50 million super yacht and mansion in Connecticut and other valuable assets around the world. And it turned out that when we dug deeper, and actually when we were first engaged, we started trying to find out more about these yachts. And this was actually already in a situation where there had been a default declared. So ideally, you would get to this earlier. But we learned, first of all, that the yacht was not actually owned by the guarantor personally. It was owned by a Cayman-based company, right, that he controlled, but it was not in his own name. And then subsequently, the yacht was actually transferred to, the spouse. And so it's a situation where, the annual disclosures by the borrower made it seem like, oh, I just have this asset that's worth $50 million. I can, cover that in itself covers part of this loan. But in reality, it wasn't owned by him, and then subsequently got transferred. So I think this is a situation where, ideally you would monitor, you do some investigation early on in the origination stage, maybe as part of a forbearance discussion, get increased visibility, demand increased visibility into the ownership structure of the assets, the location of the assets, and then obviously if you're at in a default scenario, and you have no other options, I guess, then you call us, and then we'll help chase assets around the world and try to lock down the yacht, as we did in this particular case. We got it locked down in Italy, where it remains today and cannot be used as a point of recovery or leverage.
I mean, the one thing I will say about that is while it feels obvious, which is if you're taking a personal guarantee or otherwise, you should check and see who actually owns the property. You would be surprised how many very, very sophisticated entities loan hundreds of millions of dollars based on these statements without actually looking beyond. So I can tell you that just in our own experience, most people do not actually own yachts. Most people own yachts through other entities that actually own the yachts. And if you don't take the step to have the other entities to sign on as guarantors, it's not going to be very helpful to you. So what's going to happen is you could wind up in years worth of litigation trying to get to the actual ultimate beneficial owner. The other example I'll give you, just another real life one, was a statement of assets in bank accounts. And the presentation of the bank accounts to the lender, and this again in the context of hundreds of millions of dollars, presentation of the bank account records to the lender, turned out we were hired to enforce a guarantee. We found out ultimately it was more than that. It turned out to be just an absolute fraud because those bank account documents were actually doctored. So rather than the lender, who's about to lend hundreds of millions of dollars, getting access to the bank itself, which Hadley's already mentioned, and actually getting their own read access so they can confirm the balances, they took the actual bank statements, which had been doctored, showed hundreds of millions of dollars in the account that actually never were there. So where we got hired to enforce a judgment, turned out it became more of a monetization exercise to see what we can actually recover, which has taken us literally all over the world to the Middle East and otherwise. So, our lesson from the lessons learned from the back end is take your time at the front end when the relationships are good, trust but verify, and that'll really set you up at the end of the day for the just in case problems arise. Now I see we have 2 minutes, so I'll give our panel a very quick softball, just a quick thought. The future of the private credit market. There's a lot written about the fact that is it correlated to the banks? There's an aspect of it that's in distress. How do you see this very, very large market sort of navigating, the next several years? You want to start, Andrew?
I'll be quick. $90 trillion of financing needs over the next 10 years is what's estimated, so massive market opportunity. Europe's about 5 or 10 years behind us, so there's opportunity in Europe. And again, those probably be the two big things I'd highlight.
Jeff?
It's going to be a wild ride. There'll be winners, there'll be losers. The winners and losers within portfolio of private credit lenders should be viewed as an entire portfolio. And I think that within industries, within individual private credit lender portfolios, the winner and loser products ought to be combined. And again, I hearken back to private credit is really private equity, one rung up on the capital structure ladder. So look at private credit portfolios the way private equity firms would look at their portfolio companies and see what synergies there are among the loans and the collateral.
Hadley?
Yeah, I think there's been a significant enough secular shift that there's enough supply-demand imbalances across different pockets of private credit. So I think people will continue to find opportunity. I think the only headwind will be how much regulation unwinding there could or could not be for the banks to be able to compete.
Yeah, well, and I think from sort of our perspective, there's always an active market for buying and selling distressed claims and judgments. So I actually anticipate that if there are going to be an increased number of default scenarios, there may be other actors who come in sort of the litigation finance world or the interested in buying claims, who may be actually interested in snapping up some of these distressed portfolios to try to monetize them with their expertise in that area.
All right, well, thank you. We had so many more things to cover, which unfortunately, a limited amount of time. We were going to get into LMEs and whether or not we see LMEs into private credit and otherwise. Basically, my practice is litigating those types of claims, but that's going to be for part 2 some other day. But for now, thank you for our panel, and thank you for having us.
Let's give them a round of applause. Thank you, Steve. We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.